Good evening. This is Tom Alexander. It is Monday afternoon, August 5th. It is about, it's not even 4:15 yet. Futures market is still trading. I want to do a special update today. Not only did we have a storm in the market, we're having a storm where I live in Charleston, South Carolina, and I have migrated to Atlanta. I am currently in my brother's basement, avoiding the storm. I'm here with my special trading assistant and attack dog in training. So if you hear her, she's in attack mode. The markets certainly are doing interesting things. Now, my thesis, if you listen to my weekend update, and you can locate that by going to alexandertrading.com, click on weekly update, and you can see what I was saying coming into today. And you can also go back in time and see what I was saying on a weekly basis. I had a bullish thesis, and I felt like we could be marking a short-term momentum low as of Friday, and that clearly was wrong. Now I'm going to say the same thing again. We could be marking a short-term momentum low today, and I will give you reasons why, and we'll take a look at that. But this certainly brings a bullish thesis into question. But I want to caution you, I'm a trader. So frankly, I don't really care if we're in a bull market or a bear market, other than my strategy and my tactics will change if we're in a bull market versus a bear market. From my perspective, bear markets are actually more fun and easier to trade because you get much more two-sided move. You get violent reactions up and down. In bull markets, you get this grind, 1% correction that lasts 2 hours, grind, and everybody's sitting there waiting for the other shoe to drop. And then 3 months later, you have this. So I don't know if this is, I mentioned this in the report that I put out this weekend. I don't know if this is a spasm, an overdue spasm in a bull market. We haven't exceeded retracement levels that you get in a lot of bull markets, or if it's the beginning of a bear trend. But even if it's the beginning of a bear trend, we're going to have incredible trade opportunities coming out of this. We are, sooner rather than later, we are close to some sort of furious rip your face off rally that begins out of the blue. And then I think even if we're in a bull market, I don't think it's just going to be straight back up from here. So let's just take a look at the charts. We'll look at a few technical things. By the way, if you find value in this, I would very much appreciate it if you would like the video and you would subscribe. I'm happy to respond to any comments that you care to share. So let's take a look at some charts here. And let's just start with the S&P, the SPX. And the SPX, we've had, you have a gap down from Thursday into Friday, from last Friday into Monday. So this is a waterfall type of decline. We're down not quite 10%. You can make the case, very easily make the case that that's normal, that you get these things in bull markets. However, this is an awful lot of conviction. And I am not one that's going to make a bold prediction. Okay, this is the for sure a bear market, or for sure this is just a blip in a bull market. I don't think you can make that call, and you don't have to make that call. Now, I do think that what is going to happen from a trading perspective, I think we're going to see the volatility continue. The immediate important levels are going to be the cash days extremes. So coming into tomorrow, it's going to be, and you can see on my screen, the SPX closed near the midpoint of its cash range. So today's cash market high will be important tomorrow. Today's cash market low will be important tomorrow. You can get an idea of what a wide range is by taking today's range, for instance, just to give you a little trading tip here. So today's range is today's range is this, and from whatever opening you get, then this is the way to calculate your range. Another way to do it is to just take it on a percentage basis, which we'll do is probably the easiest way to go. So today's range covered about 2.5%. So tomorrow morning, if the market gaps up or gaps down, you can get an idea about what a wide range recently has been to help give you some sort of parameters both up and down. And that can be helpful. That's practical trading information. And again, I'm not in the business of making bold predictions about, okay, the market hit some sort of magical retracement number and we're about to bounce to the next magical retracement number, or we're about to decline to some magical retracement number. From an auction market perspective, the next significant level is going to be down here near these lows that we formed in April. Now, that doesn't, and I said this on Friday, I didn't have any great number below Friday's close, except for this pivot here. Well, we closed right at it. We spiked below it. Well, the next level from an auction market perspective is down around 5,000. Does that mean we get there? No, not necessarily, but it is a level of significance as defined by actual buyers and sellers. And that's how I determine potential support, potential resistance, or more importantly, inflection points. Okay, so that's the SPX. Let's take a look at the NDX. And the NDX actually closed above the midpoint of today's cash session range, but it's also had a very severe decline relative to the SPX. It's down about 16%. Let's look at the Dow. And the Dow was relatively weak. It is now close to, or from high print to low print, off about 7%. And then the Russell, which has just absolutely been hammered. And I've been saying this, the Russell for me is really important to the bullish case. And I highlighted this area right in here in the weekend report as being absolutely critical. Well, we spiked through it and we closed in it. We spiked right to the 200-day moving average, which is the technical average that the institutions pay attention to. We're down a little over 13% from the print high into this low in 1, 2, 3, 4 days. I mean, that's basically a mini crash already in the Russell. And then if we look at the New York Composite, which is a very broad index, it's all the stocks listed on the NYSE. We're down 7%, but that 7% again has occurred in waterfall decline type of fashion. Okay, so let's take a look now at some things that I think are very important. Let's look at the internals of the market. And if we look at the VIX today spiked to 65. That is quite an extraordinary reading. Now it closed here. This is where it closed. It closed at 38 and change right in this area. So it's going to close. It closed well off its high up here. But just to give you some perspective about the magnitude of the spike that we saw at the opening, the last time we saw volatility at these levels was back in 2020, and it did spike higher in that time frame. Let me do this. This was the spike print high. Then we go back to 2020, and you can see we spiked higher on May 12th, and then we started. We traded. VIX actually spiked higher than that. The initial spike above 65, where we were today, occurred on May 12th. And then we spent about a week at higher levels. So those of you like me, I like to play volatility. You have to keep this in mind. Volatility can go a lot higher than it went today, and it can stay up for an uncomfortably long period of time, even if it is inevitable that it regresses back under this 60 level. And it is certainly going to do that. Nothing is certain, but that's pretty certain. Unless there is some sort of absolute debacle that we don't even want to think about, volatility will come in at some point, even if price goes lower. But just to put the magnitude of today's spike into perspective, the last time we came close to what we saw today was back in 2020. And then before that, let's see, how far back do we have to go? Let's see. A long time. You can see 2020 was unusual. So today you can see I'm already back in 2013. Let's see, did we spike up in 2010, probably 2008 would be my guess. Let's see. Yeah, here we go. Okay, so this was the great financial crisis back in 2008. So, was today a shot across the bow and a warning that we're going to spike up close to 100 before it's all said and done? I don't know, neither does anyone else, but this is a heads up that those things can happen and are likely to happen again. Now, if it's going to happen this time, I don't know. But this is certainly an area, if you are a volatility trader, where it gets your attention and maybe you start building a position, but that's up to the individual. I'm not going to give you investment advice. I will say though, that when you see spikes like this, you start to consider the idea that we are forming some sort of momentum low, especially if we're in a bull market. Now, if we're in a bear market, then maybe we're going to go higher and stay higher for a week or so. So that's the $64,000 question at the moment. But you can see we had a tremendous drop in VIX during the trading day. So that's a net positive. It's not like we spiked up here and we're closing on this high. So that's somewhat of a net positive. Now, something else occurred today that I think is important, and that is something that has not occurred in a long time as well. Breadth. And breadth, the histogram is closing breadth. We closed negative 2351. Let's just mark that and we'll go back and see how long it's been since we did that. So right here. And let's see, how long has it been since we closed? Well, let's see, close to it in February of this year. And that marked an immediate low. And then you get back into 2023. This was a short-term low heading into these lows. So again, this extreme type of reading is a heads up to consider the idea that we're at least putting in a momentum low, and particularly that we could be forming, especially if we are in a bull market, a low of great significance. And this 5,000 area, and we're not that far above 5,000. I mean, it would take, this is the next area. If selling persists, if we get to this area, we're either going to bounce strongly from there, or you're truly in some sort of short-term waterfall decline, and maybe we have that mini crash, something similar to some of the months that we saw in 2020. 1987 was a crash that lasted about 3 days. 2020 was a crash that lasted about a month, 4 or 5 weeks. And then you had the bear markets of 2000, the bear market of 2007 that lasted over a year and a half, 2 years. So where are we in the naming of things? I don't really know, but I do know from a trading perspective, this has my attention. I think volatility, regardless of whether we're in a bull or bear market, is likely to continue. If we're in a bull market, we're probably going to have a bottoming process where we get some sort of furious rally and some sort of deep retracement of that rally. And maybe we chop and churn around in a relatively wide range, which is an absolute ideal scenario for traders. Again, hope you guys found this of value. If you did, please like, please subscribe. Those of you that are members, I will post an update in the membership section in the morning after we see what happens in Globex. You guys have a great evening. I'll speak with you again soon.